Welcome to Endless Finance. Let's recap major stories of past week. S&P 500 minus 1.6%, Dow Jones minus 1.2% over the last 5 days. NYSE minus 0.24% for the week. They all turned positive on Friday and tried to erase negative points partly. Nasdaq minus 3.04% for the week after a rally of 29.69% for the last 6 months. Nvidia closed at $182.16, marking a 3.15% daily decline and extending its weekly losses to over 7%, erasing roughly $800 billion in market cap since Monday. The correction, while substantial, unfolds after a historic 2-year rally that lifted the company to a $4.38 trillion value, briefly making it the world's most valuable publicly traded company. Investors are re-examining AI's near-term profitability, with growing doubts over whether the extraordinary pace of AI-driven demand can maintain its intensity through 2026. Nvidia still commands about 92% of the discrete GPU market. The rally in gold this year has been fueled by geopolitical uncertainty, expectations of rate cuts, central bank purchases, and strong gold-backed ETF inflows. You see a list of analysts' latest forecasts for 2025 and 2026 gold prices in dollars per ounce, updated by end of October data. Most institutions expect gold to rise meaningfully from current levels through 2026. The average 2025 forecast across the group is roughly $3,400 to $3,500 per ounce, and the average for 2026 forecast is around $4,400 to $4,600 per ounce. Some banks are very bullish while others remain cautious. Tokenized gold AUM is growing faster than gold ETFs since late 2022. Tokenized gold AUM surged over 250%, while gold ETFs grew around 180 to 200%. ETFs will remain dominant among conservative investors, but tokenized gold is gaining traction as a next-generation store of value. Gold ETFs trade only during market hours and have management fees, whereas tokenized gold trades 24/7 with on-chain proof of reserves, often providing greater transparency. Tokenized gold can be used as collateral, lent out, or staked in decentralized finance protocols, giving holders extra yield potentials. New York Fed President John Williams said the Federal Reserve may soon start buying bonds again to make sure there's enough cash in the financial system. He added that central bank recently stopped shrinking its balance sheet and could begin slowly expanding it. This isn't meant to boost the economy, it's just to keep things running smoothly. The Fed is watching money market signals closely and wants to avoid liquidity shortages. Analysts think bond buying could restart in early 2026. The signals bond yields could ease slightly, especially at the front end if purchases begin. Federal Reserve Vice Chair Philip Jefferson backed a recent rate cut due to job market concerns, but urged caution on future cuts. He said policy is now closer to neutral and should move slowly from here. With the government shutdown delaying key job data, officials are relying on mixed private reports. ADP showed modest job gains, while Challenger reported major layoffs. Several Fed leaders expressed uncertainty about a December cut, citing inflation risks and limited data. Okay, turning our attention to Canada, Rosenberg Financial Group just released a report summarizing Canada 2026 federal budget. Let's look into this a bit. Canada's budget contains modest fiscal stimulus, but the growth outlook is still very poor at just 1.2% for 2026, with much of the fiscal effect not coming until mid to late 2026. This will do nothing to derail the Bank of Canada's easing path, and we'll still see structural Canadian dollar weakness over the next 12 months. Sector winners include defense, housing, and selected Canadian export firms. Canada's overall fiscal position remains much better than that of other major economies due to its low debt levels. Canada's labor market. Canada gains a surprise 67,000 jobs in October, beating economists' expectation. Unemployment rate edges down to 6.9%, but is still higher than experts would like. Obviously better than 7.1% expected, but it's still not good. Average hourly wages increased 3.5% or $1.27 to $37.06 in October compared with the same period last year. See you next week.